Stop whatever you're doing right now and pay very close attention to the screen. The massive signal that just appeared in the global silver market is one that most traditional investors have never encountered in their entire financial lifetime. Not once in 20 years of obsessively watching these markets have we seen this alignment. What we are covering today is absolutely not a basic price prediction or a temporary market glitch that will reverse tomorrow. It is a violent convergence of three completely separate and independent macroeconomic data points. We are tracking three massive events happening simultaneously in completely different corners of the global financial system. When you finally understand what each one means individually, and then understand the terrifying power of what they mean together, it will become undeniably clear that we are standing at a historic threshold. This is a structural breaking point. Silver is currently trading today at exactly $73.63 per ounce. Gold is quietly sitting at $4,621.40. If you only watch those digital numbers tick up and down on a screen, you might think silver just had a solid day. But you're entirely missing the underlying structural forces that are quietly and permanently rewiring the physical reality of this entire market. We are literally witnessing the complete dismantling of a massive artificial paper paradigm and the return to tangible physical value. The central banks are losing their absolute control over the narrative. The hyperscale artificial intelligence servers are demanding physical resources at a pace that breaks traditional supply models. The paper illusion is finally fracturing under the crushing weight of physical reality. The smart money knows the old simulation is dying. You are about to see the greatest wealth transfer in modern history unfold right before you. By the end of this deep dive, you will understand exactly why the mechanism that drives silver has just been fundamentally altered. We will prove why this specific cycle is categorically different from any cycle that came before it in modern financial history. First, we are going to look deep inside the futures exchange. The raw data bleeding out of that market right now is unlike anything recorded in over a full decade. It is the exact type of data that historically appears immediately before something incredibly violent happens to the upside. Second, we will expose a massive systemic paradigm shift completely ignored by the mainstream financial press. A major corporate entity has just purchased physical silver directly as a treasury asset. Not gold, not a digital currency, but physical silver. We will explain why this single act is the first ripple of a massive wave introducing an entirely new category of institutional buyer. Third, we will analyze the current sentiment picture inside this community. We will draw on deep Jungian archetypes to prove why the intense discouragement that precious metals investors are feeling today is not a sign of a dying market. According to documented historical patterns, this extreme despair is the exact psychological environment from which the most explosive upward moves are always born. These three macroeconomic stories are not separate, isolated events. They are intricately connected and actively feeding one another in a compounding feedback loop. Together, they are building an unstoppable structural pressure system underneath the global supply chain that possesses only one possible release valve. The financial simulation relies entirely on the illusion of infinite paper, but we are entering an era dictated by absolute physical scarcity. The rules of the game have changed forever, and the institutions are desperately trying to position themselves before you realize what is happening. We are going to decode their entire strategy piece by piece so you can front-run the massive capital wave. Let us begin right now by completely tearing apart the exchange data. Let us start with the futures exchange, because what is happening inside that market right now is not receiving nearly enough attention. Among the people who actually understand how the price of silver is constructed, managed, and ultimately how it can break, open interest is the only metric that truly matters. Open interest has just collapsed below 100,000 contracts. We have not seen open interest at this 12-year low since 2013, with some readings pushing toward territory not visited since 2009. Let me be very precise about why that specific number is not just another market statistic. It is a massive structural signal. Open interest represents the total number of active futures contracts, which are essentially paper promises to deliver silver at some future date. For decades, this number sat heavily elevated as the operating infrastructure of price management. Huge banks and commercial traders could flood the futures market with short contracts, creating artificial supply that suppressed the price. More paper equaled a lower price. It was a simple, effective, and durable mechanism that held the illusion together for years. Today, that participation is completely collapsing in real time. Paper traders are abandoning the market at a record pace. What makes this collapse extraordinary is that just 1 week ago, the exchange actually cut its margin requirements. They deliberately made it cheaper to hold a futures position. That is the primary lever used to attract and keep paper participants. They pulled that lever and it did not work. Open interest continued to fall even after the cost of staying was significantly reduced. The paper traders looked at the discount, acknowledged it, and kept walking straight toward the exit because they no longer trust the system. They see the writing on the wall. The era of controlling physical reality through digital paper manipulation is reaching its ultimate conclusion, and the smartest players in the room are getting out while they still can. While the paper market hemorrhages its participants, the registered inventories in the physical vaults continue to shrink at an alarming rate. Both sides of the ledger are now declining in parallel, creating a vacuum in the center of the financial system. For every single ounce of physical silver currently sitting in the exchange system, there are approximately 7 outstanding paper claims. As the paper side of the market contracts and the physical side drains simultaneously, those remaining paper claims are being supported by progressively less real metal. The gap between the promise and the deliverable is widening at a pace that cannot be sustained. You must understand that markets built on empty promises rather than physical reality do not resolve through a gradual adjustment. They resolve suddenly, violently, and without warning to the masses. This is the exact configuration that serious macroeconomic analysts have spent years watching for with bated breath. The suppression mechanism is not just weakening, it is visibly failing in the open, even after its operators tried to reinforce it with cheaper credit. We are looking at a system rapidly approaching its absolute breaking point. The illusion of infinite supply is finally crashing into the hard, cold reality of finite matter. But as significant as this exchange breakdown is, it is only the first piece of a much larger puzzle. It is not even the most underreported development happening right now in the global economy. Beneath this surface-level volatility, a new breed of buyer has entered the arena, and they are not interested in trading digital contracts. They are securing the physical infrastructure of the future. The transition from a digital illusion to a physical reality is being led by the very companies that define our modern technological existence. This shift represents a permanent departure from the old ways of managing corporate wealth. The era of the paper shield is over, and the era of the physical anchor has begun. We are moving toward a moment where owning the asset is the only way to survive the transition. The story that will matter most over the coming years, and that is receiving almost no mainstream attention at this moment, is a fundamental shift in corporate strategy. A major corporate technology company has just placed its first purchase of physical silver. A hyperscale artificial intelligence data center company completed the acquisition of 10,000 ounces of .999 fine silver. This was not an investment fund play, and it was not a speculative hedge. It was a purchase of physical silver as a core treasury asset. This puts silver in the same category where corporations traditionally hold cash, money market instruments, or government bonds. Their disclosed plans include scaling that initial purchase to 100,000 ounces within their first round. To understand why this matters, you need to look at the framework of what happened when companies started putting digital assets on their balance sheets. That trend began with one company making a decision that seemed eccentric at the time. Then 2 companies followed, then 5, and then the question became impossible for any chief financial officer to avoid in their board meetings. The first company to do it established a template. It proved the concept was legally and financially viable at the corporate level. Once something becomes boardroom acceptable, the institutional gravity of peer pressure and career risk turns it into boardroom expected with remarkable speed. Silver is now on that exact same trajectory, except silver carries something no digital asset can replicate. Silver has a massive industrial floor. The companies that will eventually put silver on their balance sheets are the same companies that already consume silver in their manufacturing processes. These entities are not speculating on a commodity. They are securing supply chain continuity while simultaneously managing their treasury. That is not a financial decision. It is a strategic operational decision. And those decisions do not get reversed when the price moves against them. The era of corporate silver hoarding has officially begun, and the available supply is simply not equipped to handle this new category of buyer. The dimension of this story that receives the least coverage in Western financial media is the massive Eastern demand side. The physical silver price in China is currently running at a sustained premium above the paper price in the United States. This premium exists because physical metal is flowing out of Western vaults toward Asian industrial demand, at a rate the paper pricing mechanism cannot absorb. This matters because Chinese demand operates on 2 simultaneous drivers that are both structural and non-optional. The first is industrial. China manufactures the overwhelming majority of the world's solar panels and consumer electronics. After the supply chain disruptions of recent years, they fundamentally restructured their procurement strategy. They are no longer ordering silver on a just-in-time basis. They are building strategic stockpiles to ensure production continuity. When a manufacturer buys silver to prevent an assembly line shutdown, they do not have a maximum price. They have a minimum quantity. They buy regardless of cost. Then, layer in the next evolution of this trend, the tokenization of physical silver, 1 token representing 1 verified ounce, custody confirmed on a blockchain. This infrastructure eliminates every friction barrier that has historically kept silver out of large-scale institutional portfolios. The argument that silver is too heavy or operationally complex disappears entirely when a digital token can be traded through the same interface. The universe of potential buyers stops being limited to retail stackers and expands to every sovereign wealth fund and family office. When the buyer universe expands by that order of magnitude, no price model built on old assumptions remains valid. The 10,000 ounce purchase we saw this week is merely the proof of concept. The companies watching the precedent are filing it away. When the second and third technology giants announce their silver purchases, the conversation in boardrooms will shift to absolute necessity. We are witnessing the birth of a new institutional asset class. Now we must address the intense emotional reality of what you are feeling right now, because this community has endured a very painful few weeks. Silver aggressively ran from the mid-30s all the way to over $80 during 2025. Then January of 2026 hit, followed by March. And the price came down from a staggering high of $121, all the way to $71. That is a brutal correction by any standard. The sentiment in the precious metals community has followed that price lower in real time. People are frustrated, exhausted. Many veteran investors are questioning whether the structural setup they believed in was even real. I want to address that despair directly, because the frustration you're feeling is not a warning sign of a dying market. It is documented evidence of a major launch phase. Bull markets do not launch from a state of widespread enthusiasm. They launch from a state of total exhaustion. They launch at the exact moment when the last marginal holder finally exits the position. That exit is the fuel for the next move. That person selling to someone with more conviction creates the compressed spring. Even with the worst sentiment we have seen in months, silver is sitting at $73.63. 12 months ago, that number was an impossible ceiling and an all-time high that nobody had ever seen. Today, people are treating $73 as a major disappointment. That is exactly what a new price regime looks like from the inside. The floor has moved up, the baseline has shifted, and the people who are unable to buy would trade anything to get in. You must recognize the exhaustion as a signal that the weak hands have been removed. The structure is now clear for the next leg up. Institutional forecasts now reflect this massive structural shift with surprising intensity. JP Morgan projects silver to average $81 across the full year of 2026. That is widely considered the conservative consensus view. However, Bank of America has released an eye-popping bull case scenario where silver reaches $309 by the end of this year. When analysts with documented track records across multiple market cycles converge on numbers this large, the question is not whether the number is extreme. The question is what would have to go wrong for it not to happen. Matt Piepenburg of Gold Switzerland is explicitly on record discussing silver targets between $150 and $200. His framing is precise and critical. These targets are not predictions that silver will magically become 4 times more valuable in real terms. They are the mathematical output of measuring a real asset against a currency that is being structurally debased. The dollar price of silver will rise not only because silver value increases, but because the dollar purchasing power is evaporating. Michael Oliver, a man with 5 decades of market experience, is now calling for $300 to $500 silver. He called the move to $100 before it happened, and his technical models now suggest the 50-year ceiling has permanently broken. The gold to silver ratio tells you exactly how much distance remains in this massive move. Gold today is sitting at $4,621.40, while silver is at $73.63. That ratio is approximately 63 to 1. The historical monetary relationship reflecting their relative scarcity in the earth is 15 to 1. Even a simple compression to 30 to 1, which is twice the historical norm, would put silver above $150. That is not a wild forecast. It is simple arithmetic. We are moving toward a historic revaluation of real assets. Against a dying paper simulation, the destination is clear. The long-term investor who truly understands these massive forces does not need to know exactly which week the next leg higher begins. They only need to be holding the physical asset when it does. That is the only decision that matters today on Friday, May 1st, 2026. The structure is entirely intact. The signals are perfectly aligned. Everything else you hear is simply noise designed to distract you. If you are holding physical silver, the paper price moves on a screen do not represent your true cost. The physical floor holds, even when the quoted price does not. This is a decade-long positioning decision, not a weekly chart strategy. You build the position, you hold the position, and you eventually exit, not for dollars, but for productive real assets when the ratio makes that exchange dramatically favorable. The paper infrastructure is retreating, and corporate adoption has been initiated. The destination is inevitable. Stay focused, stay grounded in physical reality. Like to break the algorithm, share to wake the masses, subscribe the channel to stay anchored in physical reality, and I will see you in the next one.